gave up managing billions to become a better investor. Episode 42, Earnings Season Insights Via Confucius. Hello. Yes, it's week 3 of the corporate earnings season. All very busy, I guess. It's been quite a busy week. I guess there are clearly important geopolitical discussions still ongoing. And of course, that's still impactful upon equity and bond prices, particularly I would say, well, bond prices, equity prices, it's interesting. I know they have generally moved down in many markets by 2-3%, in some individual stocks, much more than that. But equities always are quite volatile during times of uncertainty, be it macro, geopolitical, important companies, inflation rate, whatever it might be. By contrast, bonds are always perceived as being the safe place to be invested, hence why 60-40 portfolios, 50-50 portfolio splits, whatever it might be, people have said for ages that that is the appropriate split for the average pension fund investor. As you know, I completely disagree with that. And my feeling is that bond prices, bond investments are not going to be as remunerative as many people have perceived them to be over upcoming years. And of course, as an investor, that's super important because what's gone has gone. What's going to happen over the next 10, 15, 20 years is much more important by definition. And I think that when I hear about people getting excited again about 60-40 portfolios, I'm kind of a little bit concerned. Yes, it may be prudent. Yes, history may suggest that it's been okay. But I think it's, as we've seen really over the last 3-4 years after the aberration that was the 2010s after all, bond prices can also lose you money. And even from a total return perspective, even if you're picking up a decent dividend yield, it doesn't necessarily mean you're going to get a positive total return. We've seen that in corporate bonds, many government bonds over the last 2-3 years after all, including, of course, this year. But my observation would be that we've got some other things to think about. It's not just whether inflation is going up. It's not just whether interest rates are going up. As you know, I think those processes are now done, frankly, in vast majority of countries. Certainly, if we look here in the UK, absolutely. As far as the Bank of England, as you know, would not be raising interest rates any further. In fact, the discussion of when to reduce them, that's an interesting one for another time. But what's kind of insightful, I think, is that bonds are having to factor in matters such as aging populations, rising debt levels, all other things which are super important for bond prices and bond valuations. And this is where I kind of think that the 2010s completely lost appreciation of these medium-term impacts. Bond yields got down to levels so ridiculously low that it couldn't be sustainable. And consequently, even though we're moving through the inflation bout, the impact on interest rates and all of that sort of thing, I still would say from a total return perspective, your average equity position, certainly a well-financed equity with probably a strong price to mix and all other positive attributes that I look for in the corporate earnings season, is still a much more attractive return for me over the next 5-10 years, whatever time period you want to look at. Hence why my bond investment is still perceived as being an appropriate investment, being your age minus 50. And consequently, if you are like myself, still sub 50, bonds are not an attractive investment for you. Sure, if you are of an older generation, it still makes sense to have some bond allocations, but that previous perception of, the right bond position was either in a 60-40 mix, or it should be your age as your bond stroke cash allocation. Hence, a 75-year-old would have 75% allocation to such investments, I think is reflective of a time when aging populations, government debt issues and related were less of a problem, even though maybe inflation per se was an issue. And as I talked about before, inflation, let's face it, has always had that capability to run at 3, 4, 5, 6% quite happily. Personal inflation rates, as we all know, are much higher than perhaps what normal government statistics and related tell us. Anyway, you've heard me say all of this before, but what's kind of interesting is that we've had reaction to both bond and equity markets to uncertainty in the world, is that a complete disaster, a complete unknown? Of course not. And as I've said before, and it would still be my perception for the rest of quarter four 2023, the final quarter of the year, I would still say that equity markets will offer a positive total return perspective over that period, and frankly bond markets too. Not necessarily for the full year for certain bond positions, but the average equity I think is going to finish 2023 offering a total return, which I think is attractive, hence why I'm still highly equity centered, still have that gold and gold facing allocation, and that's obviously worked out well over the last couple of weeks. That is just the role of gold after all. Yes, I know that some people will say, well, of course you could have a whole load of cash and then that's not going to go down, and even though there's a bit of inflation, that's very workable at these times. And of course, you're absolutely correct. During the days around the time when a market is falling or there is a negative return, the trouble with with cash allocations is, of course, that sadly you never put your money back in, or if you do put it in, you don't put it in at the time you should be doing, which is when you have excessive fear unrelated. And I noted that we did end the week at fear indications just off the excessive fear or high fear kind of levels, which of course indicate a point when matters are interesting and investors should be thinking about putting equities certainly, and maybe overall investment allocations into play. But there you go. What have equity markets told me over the last week? Well, it is, unsurprisingly, an active investing world. We know that already. I've said that far too many times for it not to be a particular surprise. I'm saying that. This corporate earnings season already is being, if it is possible, even more active than let's say the quarter two or quarter one earnings seasons earlier this year. And I say that looking at sort of the performance of 4 or 5 names that have reported their numbers in the last few business days. You know, when I look at companies such as ASML or Roche or Mondi listed in the European markets, pan-European markets, I would say all three, frankly, were still broadly performing as I would have expected. There were no huge mega surprises in any of their announcements, but on the day, a little bit less for ASML and a little bit more, though, for Roche and Mondi. You had volatility in their share prices. And I found this interesting in the sense that I understand if a company, in the case of, let's say, a Roche, which often raises its full year targets in quarter three after being a bit cautious in the earlier part of the year, you know, a bit of caution in order to beat easy comps and all of that sort of thing. They held their numbers. They talked positively about many areas in the pharma sector that they're currently working on. And to me, I can still frankly get a 300 Swissy Roche share price without working too hard, plus pick up a dividend which is pretty competitive against many mainstream government bond options out there. We won't mention where Swiss bonds, for example, Swiss government bonds are currently yielding. But the thing is, pharma seems to be a bit out of favour at the moment, and I don't wholly understand it. Yes, I know that there's a little bit more competition. Yes, I do know that governments around the world are trying to strike better deals, partly due to aging populations. But you can kind of walk that around the other way too, where if you've got good products, if you've got, yes, some comps against some COVID positives, which are still impact some of your shorter term numbers, but everyone should already be looking ahead of all of those issues. I'm surprised to see Roche shares under a bit of pressure. They've got a number of announcements upcoming over the next couple of months. I remain positive, to be brutally honest, and surprised by the reaction of the shares, at least over the last couple of days. ASML shares, I did notice, started to recover a bit after their on-the-day fall in the middle of last week. And I'm not surprised by that recovery because, again, I was impressed by the numbers. Look, the world of technology, of chips and related can be a volatile one. ASML, obviously, as a supplier to the chips industry per se, has some extra potential leverage both ways on this, particularly, of course, given their critical position in the supplying of chips-related equipment. And certainly reading also, which came out, the TSMC numbers came out during the week as well. And again, ASML's in an excellent position from a medium-term perspective, the foreseeable medium term, let's put it that way. And certainly, even though I can understand a sort of quite firm valuation if people aren't making it a core holding at prevailing share prices, if you are a holder, there's nothing to worry about. If you have, and frankly, at either side of 600 euros a share, ASML is a solid hold at the worst. So if you've got a shareholding in that one, I really wouldn't be worrying about it too much. 500 euros, I think it's an overbuy. 700 euros, a sell, in my opinion. Of course, all of this is my opinion. But we shall see. So ASML was fine and reacted a bit less on a kind of a 24-hour perspective. I think the TSMC numbers coming out kind of helped that a little bit in terms of the perception towards it. Mondi, which is obviously some quite broad ranges to the company, paper, packaging, and related matters, more packaging than paper today, I would say. Issues in terms of I think the pricing power has been all right, but in terms of certain issues in terms of underlying some shorter-term demand adjustments, but fundamentally the packaging business in particular, I still think it's in a strong role with its positioning in the consumer and industrial sector, and there's not many peers of Mondi to deal with globally. Not one certainly of their broad range of expertise. The DS Smiths of this world. Very few other ones though really would compete against the company positively. So really, I've added twice to the company to my position in Mondi over the last year. And if I see the company's shares below £12 again, I probably would add further on the basis that strong balance sheet, less than 1 times EBITDA multiple, debt to EBITDA multiple. Valuation teams at worst, to be honest, even being conservative about shorter term issues. Strong market share position, relevant for the rest of the 2020s and 2030s, as far as we can see. And let's face it, it fits in. These are companies which, from an ESG perspective, I know not an area which many people will be very excited about as a driver for investment decisions. But let's face it, when I look at the average institutional investor today, it's becoming more and more of a relevant driver, rightly or wrongly, as you wish to perceive. But my observation would be Mondi is a positive still. I still can quite easily get a much firmly higher share price, let's say over 1,500 pence a share target, plus picking up that attractive dividend yield. So remains a buy for me, or strong hold, let's put it that way. As I say, personally, given my current reasonable position, would be waiting for a sub £12 share price for potentially adding further, just because of where I am. Elsewhere, in the States, we've had some interesting numbers from, we've got WD-40 out, a company just talked about on a previous podcast. Very interesting company, underappreciated, well-known product, of course, but underappreciated, I think, because it isn't the biggest company in the world, but a very intellectually interesting company, some very strong underlying both driving strengths of its business, of its product range, and related. Lots of scope for international growth would be my perception. Is the share cheap at the moment? I am waiting still for that $200 share price. As I talked about in the previous podcast, I talked about the company, and hence I'd be chilling at the moment, just because of the quality of the company. If you hold the share, it's still a hold. But in terms of me getting back into the company, having made great returns on previous times, I'd still be hanging around waiting. FCX, obviously in the copper, gold and related areas, fascinating company. And Freeport McMoran is a name which I've done very well out of in previous times. And I think when I look intellectually, if you're looking for a diversified copper gold sort of focused name, you struggle to find a better one today. If you're a little bit more gold centered, then obviously the Barrick Golds reporting in early November would be more fascinating. if you're looking for pure copper plays, I'd say an FCX, a Freeport-McMoRan would be a bit more up your street. Positives were, it was a solid set of numbers. Yes, we all know that copper prices are a little bit lower than they were a little while ago. Yes, much of the high enthusiasm towards commodity names, mining sector names have gone away a little bit. But if you see that the Freeport-McMoRan share price number below $35 a share, I think it's a core kind of medium-term purchase, really. Obviously, little not so much from the dividend, a bit more from the buyback level, but that's not the story here, I don't think. This is not like a sort of a Rio Tinto or a BHP Billiton sort of mining place. It has a little bit more kind of what I would call natural, overt value perspective to it. And consequently, a company which, if you see it below $35, I tick the box and say it's a good buying opportunity. That would still be my perception. Let's face it, when you look at, forget the gold enthusiasm, which I often usually have. Copper is a fascinating mining area for that kind of into the next decade perspective, just because of its importance in the sort of the industrial and related backdrop that we see in not just cars, but in life in general. We know that obviously copper's always had that association with the development of housing markets and related, but when we see in next generation opportunities for the reduction of matters concerning climate change and related, clearly copper has an important role to play there, and hence Freeport-McMoRan, I think, it's an interesting company, much more interesting than perhaps people would naturally think. So for me, any stock below $35, anytime below $35, I'll be buying the share. As simple as that, really. So that's sort of the last week. So as I say, kind of interesting, lots of sort of slight ifs and buts in share price. That's just telling you that, yeah, market investors have an uncertainty aspect at the moment. It's also telling you that you have to be thinking about your investments more than certainly during the 2010s or even in the certain parts of this decade than people have been. And you've got to accept some volatility with it. But if you look medium term, it should always be a 12 to 18 month minimum investor, in my opinion. You can find plenty of good opportunities out there, I would still say. The upcoming week is week 4 of the corporate earnings season, is the busiest week. Maybe week 5 is just as busy. Weeks 4 and 5, let's put it that way, are both the busiest parts of the corporate earnings season. We have so many important names coming out from, the technology sector, everyone would be a lot focused on, consumer, industrial, some more pharma names, and related. So super exciting times, busy times, but exciting times. And of course, it's always good to be busy after all. You're probably thinking, why have I called this, why have I mentioned Confucius on this, and why suddenly he made an appearance on this? You'll see on the pod write-up that there's a quote from Confucius, which I thought was kind of relevant for the sort of, not necessarily the prevailing environment, for investment thinking and related generally. And I just came across it and I thought, yes, this kind of captures the focus of what I'm trying to center on in this podcast in any case. So a few words of Confucius for you to look at your leisure. But thanks so much for listening. We're going to have a busy next week. So next week's podcast is going to talk about 1,001 different companies, no doubt, in a variety of sectors across various parts of the world. But hey, if we don't have anything to say next week, then we never will, right? So it's going to be busy and exciting, but lots to talk about and lots to follow. As an investor, stay relaxed, stay thoughtful, but stay involved. That's the key and most important thing, as always. Thanks for listening. Speak to you soon. Bye-bye.